Usually, when we sit down to analyze a modern business for a deep dive, we're looking at, well, clean lines of code in a cloud server somewhere.
Yeah, exactly. Software.
Right, software.
Yeah.
It's incredibly sterile. It's binary. You point to a subscription dashboard on a screen, and you can trace exactly where the product is and where the revenue comes from.
It is very comforting to categorize things that neatly. I mean, software as a service, recurring revenue models, they exist in this frictionless digital vacuum.
But then you step into the world of heavy industry, right?
Mm-hmm.
Into actual physical infrastructure. And that frictionless model just shatters completely.
Well, absolutely. It doesn't apply at all.
Today, we are looking at a corporate empire that is built quite literally out of dirt, fire, and sweat.
Dirt, fire, and sweat. I like that.
It's true. We are unpacking a massive stack of financial analysis, operational reports, and market research that was shared with us, all concerning the company called Godawari Power Ispat Ltd. Or, for the sake of our sanity today, GPIL.
Yeah, let's definitely stick to GPIL. And what's fascinating here is that GPIL isn't just a company that happens to sell steel.
Right.
They are a living, breathing masterclass in what business schools refer to as vertical integration.
Which is a term that gets thrown around a lot.
It does, but to really understand this, we have to pull that concept out of the academic textbook.
Okay.
We're talking about an operation that claims ownership of the literal ground the iron is ripped from. They generate the massive amounts of electrical power required to forge it.
Wow.
And then they manufacture the finished, high tensile wires that physically hold modern cities together.
So they own the earth and they own the fire.
Precisely.
When you strip away the corporate jargon, it is an incredibly primal business model.
It really is.
But to truly understand why a company like GPI matters to anyone listening to this deep dive, whether you are, an investor hunting for misunderstood value, a business strategist dissecting supply chains, or just insanely curious about how the physical world around you is constructed, we have to zoom out first.
Yeah, we need the macro context.
Exactly. Set the stage for us. Where does GPIL operate, and what are the stakes of this game?
So if we connect this to the bigger picture, we are basically standing at ground zero of the Indian modernization machine.
Okay.
The macro context of India's steel industry is just staggering on a historical level. You are looking at a nation of 1.4 billion people.
Right.
And they are undergoing one of the largest mass migrations in human history, millions of people moving from rural agricultural centers into rapidly expanding urban megacities.
And, you cannot build a megacity out of wood and hope.
You cannot. You absolutely cannot. That demographic shift creates a ferocious, almost insatiable demand for new physical infrastructure.
We're talking bridges, roads.
Everything. Thousands of kilometers of new highways, suspension bridges, high-rise residential towers, and sweeping expansions of the national power grid.
And steel is the skeleton of that entire modernization machine.
Precisely. It's the skeleton. And GPI operates right in the beating heart of that skeletal system.
Now, on paper, if you look at the financials, analysts categorize them as a mid-cap company.
Right.
In the notes, they're specifically flagged with a mid-core style rating.
Yeah, but we really have to contextualize what mid-cap actually means in India's heavy industrial sector.
Because it's not a tech startup.
No, this isn't a nimble startup with 300 employees sitting in a co-working space drinking oat milk lattes.
Right.
GPIL commands a massive physical footprint. They employ 5,947 people directly.
Wow. Almost 6,000 people.
And they operate at the center of an industrial ecosystem that generates roughly 12,000 crore rupees in revenue.
Which, for anyone doing the mental conversion, means we are analyzing a multi-billion-dollar operation.
Oh, yeah, multi-billion.
And they're doing this in a sector that is notoriously brutal. Heavy industry is heavily regulated, it's incredibly capital intensive, and it's entirely at the mercy of wildly swinging global commodity cycles.
It is an unforgiving landscape. Mm-hmm. Totally unforgiving.
Right.
One sudden drop in the global price of iron ore or, an unexpected spike in the cost of industrial coal can completely vaporize a steel company's profit margins overnight.
Okay, let's unpack this, because that is exactly why GPIL is such an extraordinary case study in these sources. How do you survive, let alone generate massive cash reserves, in an environment where the macroeconomic weather can literally wipe you out?
That's the million-dollar question, or, multi-billion-dollar question.
To figure that out, we have to start by looking at their anatomy.
Right.
Before we can understand how they generate money, we We need a clear picture of what they are actually physically producing every day. Because reading through this source material, they definitely do not just make one thing.
Far from it. They make everything.
Yeah.
Well, when most people hear steel company, their mind immediately goes to, like, a massive I-beam being hoisted by a crane or rolls of shiny sheet metal.
Sure, the classic construction site image.
Exactly. But GPL's product catalog reads like an inventory sheet for an entire industrial supply chain.
Lay it out for us.
Okay, so they produce raw iron ore pellets. They produce sponge iron, which the industry calls direct reduced iron, or DRI.
Okay, pellets and sponge iron.
Then they cast steel billets, they roll wire rods, they draw hard black wires.
That's a lot of metal.
And on top of that, they manufacture ferro-alloys. And they even capture and sell industrial gases.
Wait, gases?
Yeah, like oxygen and nitrogen that are basically byproducts of their massive furnaces.
Wow. And we haven't even touched the energy side of this yet.
No, we haven't.
The reports highlight that they generate captive power. They're operating 53 megawatts of thermal power and 20 megawatts of biomass power.
Right, which is huge.
They actually produce so much electricity that they sell their excess back to the national grid.
They are a net exporter of power.
And just to add, another layer of complexity, they are currently expanding into manufacturing physical containers for battery energy storage systems.
Which they abbreviate to BES.
Right, BS containers, along with cold-rolled products.
Yeah.
It is genuinely dizzying trying to keep track of it all.
It is overwhelming if you just look at it as a list on a piece of paper. To really grasp it, we need to map the actual physics of the steel value chain step by step.
Let's do it.
Let's use GPIL as the model to trace how a raw rock buried deep in the earth eventually becomes the high-tensile wire holding up a suspension bridge.
I love this. Where do we start?
The journey begins with mining. You literally blast raw iron ore out of the ground.
Right. Explosives and dump trucks.
Exactly. But raw, unrefined iron ore is full of impurities. It's full of moisture. You cannot just back a dump truck up to a furnace and throw dirt into the fire.
Right. It would just choke the furnace out completely.
Exactly. It requires an intermediate step. So GPIL takes that raw, crushed iron ore and processes it in a specialized plant to create what are known as pellets.
Pellets, okay.
Imagine taking fine iron dust and baking it into small, incredibly dense, concentrated marbles of iron.
Okay. Like iron marbles.
Yeah. These pellets are uniform in size and chemical composition, which makes them vastly more efficient to melt down later on.
But they don't melt them down right away. There's another chemical step first, producing that sponge iron you mentioned earlier.
Yes, the direct reduced iron process. And this is fascinating chemistry.
How does it work?
GPIL takes those dense iron pellets and exposes them to extreme heat in the presence of carbon.
Where does the carbon come from?
Usually from coal or natural gas. But crucially, they do this without actually reaching the melting point of the iron.
Wait, really? They don't melt it?
Nope. The carbon reacts with the oxygen trapped inside the solid iron pellets and essentially strips it away.
So you are basically pulling the oxygen gas out of a solid metal rock.
Exactly. And because the oxygen leaves the structure, the resulting iron is suddenly full of microscopic holes. It becomes incredibly porous. If you looked at it under a microscope or even just held a piece in your hand, it looks remarkably like a hardened metallic sponge.
Hence the name sponge iron.
Right. It's highly concentrated iron, completely stripped of oxygen, ready to be melted.
Okay, so we have the sponge iron. What's the next step?
So you take that sponge iron, you add some recycled steel scrap to the mix, and then you add the seasoning.
The seasoning.
The ferro-alloys. GPIL produces these alloys themselves, things like silicomanganese.
What do those do?
These alloys dictate the final properties of the steel. Do you need it to be more flexible, more resistant to rust, harder? The alloys determine all of that.
Sort of very specific recipe.
Extremely specific. You throw all of this into an induction furnace, blast it with massive amounts of electrical power, and melt it down into liquid metal.
Okay, we finally reached the liquid metal stage.
Yes.
And then that gets poured into molds.
Yes. It gets continuously cast into what the industry calls steel billets.
Billets.
Right. A billet is essentially a massive, thick, heavy bar of raw, semi-finished steel.
Okay.
If a painter works on a blank canvas, a billet is the blank canvas of the heavy industrial world.
I like that analogy. It's the baseline material that gets transformed into the final consumer product.
Precisely. From there, GPIL takes those heavy billets, heats them up again until they are glowing red and malleable. And then they send them through a massive rolling mill. This machine physically squeezes and stretches the billet, rolling it out into a long, continuous wire rod.
Wow. Just stretching solid steel.
Yeah. Then, in an even more specialized facility, they literally pull or draw those wire rods through increasingly smaller dies.
To make them thinner.
Exactly, to stretch them even thinner, creating hard black wires or HB wires.
And those wires are what finally leave the GPIL ecosystem. The end customers buying these long products are industrial manufacturers in the construction sector.
Right, engineering firms and companies that make fencing, nails, and binding wires.
The entire journey from the bedrock to the building site, all under one roof, essentially.
Exactly.
Okay, you want to pause here and ground this with an analogy, because the sheer operational bandwidth required to do all of these things simultaneously is just hard to visualize.
It is. It's massive.
So imagine the standard manufacturing company is a bakery.
Okay, a bakery.
Most bakeries operate by buying a pre-mixed box of cake flour, adding water, and baking a cake. That's their whole business.
Right. Simple and focused.
If we apply that to GPIL, they aren't just baking the cake. GPIL is out in the field planting the wheat.
Right.
They are harvesting the wheat. They are running the grist mill to turn it into flour. They own the chickens that are laying the eggs. They're churning their own butter. They're baking the cake.
And selling the cake.
And then, just because they have the infrastructure, they're selling the excess heat from their oven to the neighbors to heat their houses.
That is a remarkably accurate way to visualize it. What's fascinating here is how aggressively GPIL refuses to rely on external suppliers.
They do everything themselves.
Yeah. In the steel industry, most companies pick a lane. They are a pure-play mining company that digs up ore and sells it on the open market.
Okay.
Or they are a secondary melting mill that buys sponge iron from someone else to cast billets. Or they are purely a rolling mill that buys billets to make wire.
Because attempting to do just one of those steps is incredibly complex and requires massive capital investment.
Absolutely. Think about what we just described. You have to manage the heavy, earth-moving logistics of an open-pit mine.
Which is a nightmare.
Then you have to manage a highly volatile, chemically sensitive pelletizing and reduction plant.
Right.
Then you have to manage heavy metallurgical melting furnaces operating at thousands of degrees. And alongside all of that, you are running a literal power plant.
It's insane.
Yeah.
Juggling heavy industrial labor relations, environmental regulations, mining leases, and local power grid negotiations simultaneously is just staggering.
It really makes you wonder how a mid-cap company manages it.
You would assume that level of comprehensive integration is reserved solely for massive legacy multinational conglomerates.
Right, the absolute giants of the industry.
So if the complexity is that immense, why bother? Why not just buy the flour like everyone else and save yourself the operational headache?
Well, that brings us to their absolute superpower. The reason they take on that immense headache is to build an impenetrable fortress around their profit margins. In the financial literature provided, there is one word that comes up over and over again to describe GPIL's strategy.
And what's that word?
Captive.
Captive.
Right.
And in the world of heavy industry, captive doesn't mean a prisoner.
No.
It means you own the asset exclusively for your own internal consumption. Let's dig into this captive mode.
This is the foundation of their entire valuation. GPIL sources over 85% of its total iron ore requirements internally.
Wow. 85%.
Yeah, from its own captive mines.
Oh.
Specifically, they operate two major iron ore mines located in the mineral-rich Indian state of Chhattisgarh.
Which mines?
There is the Ari Dongri mine, which is currently undergoing a massive expansion. They're taking it from a capacity of 2.35 million tons per annum up to 6 million tons.
That's a massive scale up.
And then there's the Boria Tibu mine, operating at roughly 0.7 million tons per annum.
And we need to emphasize that these are not just little surface scratches that are going to dry up in a few years.
Definitely not.
The geological surveys and the sources highlight that these mines hold 165 million tons of proven iron ore reserves.
That 165 million figure is the most important number in their entire operational profile.
Why is it so crucial?
To put that into perspective, 165 million tons of iron ore translates to an operational lifespan of more than 35 years at their current extraction rates.
35 years. Wow.
They have guaranteed, effectively at cost, access to their most critical raw material until roughly the year 2060.
Okay, let's unpack this because this leads to a very obvious question for anyone listening.
Sure.
If this captive model is so ridiculously profitable, if owning the dirt is the ultimate cheat code for printing money in the steel industry, Why doesn't every single player do it?
It's a fair question.
Why don't giants like Tata Steel or JSW just go out and buy a massive mine next to every single one of their processing plants?
Because you cannot just conjure an iron ore mine out of thin air, regardless of how deep your corporate pockets are.
Right.
The barrier to entry is astronomically high and is built on 3 pillars.
Okay, what's the first pillar?
The first pillar is pure geological luck. The iron ore has to actually exist in the ground, and it has to exist in a concentration and grade high enough to justify the massive expense of extracting it.
You can't just zone an industrial park in downtown Mumbai and start digging for iron?
Exactly.
Yeah.
Chhattisgarh happens to be one of those rare, geographically blessed regions.
Okay, so you need the luck of geography. What's pillar 2?
Even if you have the geological luck, that only gets you to pillar 2, which is the regulatory labyrinth.
Ah, the red tape.
The bureaucratic nightmare of opening a mine in a developing economy is immense. You have to secure environmental clearances, you have to secure forest clearances.
Why forest clearances?
Because often these mineral deposits are located under protected lands or dense forests, you have to negotiate mining leases with state and central governments.
Which takes time.
These are processes that can take a decade of lobbying, environmental impact studies, and legal battles.
A decade just to get permission to dig.
Exactly. And the third pillar.
Yeah, was this the third?
Massive land acquisition hurdles, negotiating with thousands of local landowners and communities to secure the physical footprint for an open pit mine.
Because the mine isn't just a hole, it's the roads, the processing plants.
Right, the logistics infrastructure. It is notoriously complex and politically sensitive in India.
But GPIL has already run this gauntlet.
They have paid the toll. The sources note recent approvals from the Indian Bureau of Mines greenlighting their expansions. They already possess the golden tickets.
And their captive moat isn't just about the iron ore, right? It's the pairing of the resources. We talked about their power generation earlier.
Yes, the ecosystem advantage. That's what makes it so powerful.
I'll explain that.
The smelting and rolling of steel requires astronomical amounts of electricity. The sources point out that while GPIL covers its power needs internally,
Through their thermal and biomass plants.
right, and they've newly added 95 megawatts of renewable solar capacity. So while they do that, its peer competitors are forced to rely on the external state electricity grid for 20 to 30% of their power.
And industrial grid power in India is neither cheap nor perfectly reliable.
It is expensive, and more importantly, it is subject to the macro whims of global coal shortages, state pricing policies, and, regional blackout risks.
Right.
By pairing their captive mines with captive power generation, GPIL isn't just cutting a middleman out of the supply chain, they are actively insulating their balance sheet from global commodity shocks.
Let me challenge that here a second, though.
Okay.
If GPIL's dirt is practically free because they pull it out of their own backyard, why do they care about global commodity shocks?
What do you mean?
Like, if the global price of iron ore spikes because a massive cyclone hits the mining regions in Australia and disrupts global shipping,
Yeah.
wouldn't that just make GPIL more competitive?
Oh, it makes them vastly more profitable. That is exactly the point of the moat.
Right.
If the global price of iron ore spikes, GPIL's competitors who buy ore on the open market see their manufacturing costs skyrocket.
But they have to raise their prices.
They have to raise the price of their finished steel just to break even. But GPIL's cost to dig that ore out of the Ari Dongri mine remains exactly the same.
Wow.
So they have a choice. They can either keep their prices low and steal market share, or they can match the higher market price of finished steel and pocket an absolutely massive profit margin.
They dictate the terms of their own survival.
Exactly.
And we can see the mathematical proof of this moat in the financial metrics provided in the sources.
The numbers are wild.
They really are. The sources show that for the first 9 months of fiscal year 2026, during a period when global steel prices were actually dropping, GPIL maintained an EBITDA margin of 22% and a profit after-tax margin of 14%.
Now, for a listener who doesn't spend their day staring at financial statements, we should probably clarify what those metrics actually mean in the context of a heavy industrial company.
Yes, please. Let's ground those acronyms for everyone. Let's start with EBITDA.
EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
A mouthful.
Simply put, it is a measure of the raw operational profitability of the business before the accountants step in and start deducting the costs of financing, government taxes, and the wear and tear on the machinery.
Okay, so it's the core operational cash generation.
Right. An EBITDA margin of 22% Means that for every 100 rupees of steel they sell, 22 rupees is pure operational profit.
Which is huge.
In a notoriously low-margin, high-volume industry like secondary steel, maintaining a 22% margin during a down cycle is phenomenal.
And profit after tax, or PAT, is exactly what it sounds like. It's the actual bottom line cash that is legally theirs to keep after every single bill and tax obligation has been paid.
Correct. Keeping 14% of revenue as pure bottom-line profit in this sector is a testament to how aggressively that captive mining moat drives down their base costs.
But to really understand how efficient this machine is, we have to look at how they deploy their capital compared to the industry giants.
Yeah, the return metrics.
The sources highlight that GPIL is nearly completely debt-free. Furthermore, they boast a return on capital employed ROCE of 23% and a return on equity ROE of 17%.
Okay, let's bring back our bakery analogy to explain ROCE and ROE, because these are critical concepts for understanding why GPIL is viewed so favorably by analysts.
Gladly. Let's start with ROCE, return on capital employed.
Imagine all the money tied up in your bakery. The physical cost of the building, the industrial ovens, the delivery vans, the flour inventory.
All the hard assets.
That is your capital employed. A 23% ROCE means that for every $100 you have tied up in the physical assets of that bakery, the business is generating $23 of pure operating profit every single year.
Wow.
It is a metric of how hard the company's physical assets are working to generate wealth.
So it proves they aren't just hoarding massive factories that do nothing. Their assets are highly productive.
Exactly.
And what about return on equity?
Return on equity, or ROE, looks at it from the perspective of the shareholders. If you subtract all the company's debts from its assets, you are left with the equity.
The actual net worth of the company owned by the shareholders.
Right. An ROE of 17% means that for every $100 of shareholder wealth retained in the company, management is generating a $17 return.
Which is incredibly impressive when you contrast it with the heavily leveraged giants in the sector.
Oh, it's night and day.
Large multinational steel companies often suffer from crushing debt burdens because they had to borrow billions to construct their massive blast furnaces.
And when steel prices drop in a global recession, those heavily indebted companies face a nightmare scenario.
Because their revenue plummets.
But their massive interest payments on their debt remain fixed. They don't change.
Which absolutely obliterates their margins and pushes them toward bankruptcy.
But because GPL has virtually no debt, and their variable costs are locked in at the dirt level by their captive mines, they just sail right through the cyclical downturns.
Which sets up an incredible contradiction. And this leads us to a really fascinating part of the research in these sources.
Yeah, the market share paradox.
Right. We have established that they possess the perfect cost structure. They manufacture their products cheaper and more efficiently than almost anyone else in their region.
Unquestionably.
Naturally, you would assume a company with that kind of dominant cost advantage is selling to everyone and absolutely conquering the market.
You would assume that.
But when we zoom out and look at the total addressable market, the TAM, in India, we hit a glaring paradox.
The scale of the Indian steel market is almost difficult to conceptualize.
Give us the numbers.
The overall TAM for crude steel in India is currently hovering around 140 to 150 million tons annually.
And the sources break down GPL's specific operating categories beautifully.
What are they?
The TAM for iron ore and pellets in India is estimated at 200 to 250 million tons. The TAM for steel billets and wire rods is 100 to 120 million tons.
And huge numbers.
Even a highly specific niche product like hard black wire represents a 20 to 25 million ton market.
We are talking about multi-trillion rupee ecosystems here.
Exactly.
Yeah.
Yet, and here is the massive paradox, GPIL's market penetration in every single one of these categories is less than 2%.
Less than 2%.
For most of their finished, value-added products, their total national market share is hovering around 0.5% to 1%.
So they are a highly profitable, deeply entrenched giant in their specific regional pond, but they are a statistical minnow in the national ocean.
So I have to play devil's advocate here.
Go for it.
If they are so incredibly cost-efficient and their margins are so robust, why is their market share essentially a rounding error?
It's a great question.
Is this a massive red flag? Does it indicate that their management is terrible at sales, distribution, and national marketing? Or does it point to something fundamentally strange about how the Indian steel industry operates?
It is absolutely the latter. It is the structural nature of the beast.
Explain that.
The Indian secondary steel sector is uniquely, almost aggressively fragmented. The sources point out a fascinating statistic. Over 60% of the secondary steel sector in India is dominated by what are called induction furnaces.
Wait, clarify that. What is the alternative to an induction furnace?
When you picture historical steel making, like the massive steel mills of 20th century America in Pittsburgh or somewhere, you are picturing a blast furnace.
Right. Big smokestacks, massive fires.
Exactly. These are monolithic, multi-billion-dollar installations that run continuously for decades, producing tens of millions of tons of steel. They require massive scale to be profitable.
But an induction furnace is different.
It uses electromagnetic induction to melt the metal. They can be built much smaller, they're much cheaper to install, and they can be turned on and off relatively easily.
Which completely lowers the barrier to entry for smaller players.
Exactly. It democratizes the melting process. And when you move one step further down the value chain to the MSME rolling mills.
MSME meaning micro, small, and medium enterprises.
Right. The guys who take the raw billets and roll them into wire or rods. The fragmentation there is even more extreme. Over 90% of that specific market is entirely unorganized.
Meaning it's not dominated by 5 massive corporations.
Yeah.
It's thousands of independent regional family businesses operating out of small industrial sheds on razor-thin margins.
Yes, so GPIL is not going head-to-head in a national marketing war against 3 corporate giants. They are fighting an attritional battle against 1,000 localized mom-and-pop steel rollers. And in the physical world, logistics dictate everything. Steel is incredibly heavy and dense. It is enormously expensive to transport over long distances by truck or rail.
So shipping kills your margin.
Exactly. Therefore, a local, unorganized rolling mill has a massive geographic advantage when selling to a construction site in their immediate 50-kilometer radius, simply because the freight costs are basically zero.
Which totally shifts the perspective. GPIL's low market share isn't a failure of their sales team.
Not at all.
It's a reflection of the gravitational pull of logistics. But that also means they don't need to invent some revolutionary new technology to double their revenue.
Right, they aren't trying to sell people on AI or something.
They don't need to convince the market to buy a product that doesn't exist. They just need to slowly, systematically capture 1 or 2 more percentage points of an existing bottomless market.
And the structural macroeconomic tailwinds pushing that total addressable market forward are historic.
Yeah, let's talk about those tailwinds.
The sources emphasize that India's current per capita steel consumption is roughly 80 kilograms per person.
Which is tiny compared to developed nations or the global average.
It is fractional. But as the economy modernizes, that per capita consumption is projected to nearly double, rising to 150-plus kilograms.
Wow.
When you multiply an extra 70 kilograms of steel by 1.4 billion people, the sheer tonnage required is staggering.
And we know exactly what is driving that demand. It is heavily backed by federal policy and demographic destiny.
Right, urbanization.
The sources highlight that India's urban population is projected to surge from roughly 36% today to over 50% by the 2040s.
That means constructing entirely new urban centers from scratch. The Indian government is aggressively pushing infrastructure initiatives.
Like what?
The 100 Smart Cities mission, the massive continuous expansion of the national highway and expressway networks. The highway expansion alone is modeled to add 50 to 100 million tons of new steel demand over the next decade.
And it isn't just massive bridges and urban skyscrapers. The sources specifically mentioned the PM Awas Yojana housing scheme.
That's a huge one.
This is a government initiative aimed at building formalized, durable housing for roughly 40 crore people.
400 million citizens.
Right, moving into formalized concrete and steel structures. Every single one of those houses requires wire rods for reinforced concrete, binding wire, and fencing.
Which maps perfectly onto GPIL's finished product catalog. They manufacture the exact structural DNA required for this housing boom.
So their incredibly low market penetration today simply means they have an infinitely long runway for growth ahead of them, provided they can scale their physical production capacity fast enough to ride the rising tide.
Exactly.
Which brings us to the segment that every listener who loves financial engineering has been waiting for. We know what they manufacture. We understand their captive cost mode. We see the bottomless demand of the macro market. But how does this immense physical operation translate into the bizarre reality of their financial statements?
This is where it gets weird.
Because there's a massive numerical contradiction in the source material that we have to decode.
This is where the story pivots from industrial engineering to a masterclass in financial leverage. Let's examine the raw numbers for fiscal year 2025.
Okay, Amy.
GPIL reported consolidated revenue of 5,455 crore rupees. But here is the catch. That revenue figure was actually down 5.2% compared to the previous year.
Okay, so their top-line sales shrank. They brought less money in the front door.
Yes. But in that exact same year, their profit after tax, the actual tangible cash they pocketed at the end of the day, was 936 crore.
And that was up or down?
And that figure was up 18.1% year over year.
Okay, here's where it gets really interesting. Break this mathematical witchcraft down for me.
It sounds impossible, right?
If I were a business and I sell 5% fewer cakes, my profits should naturally go down, or at best, stay flat if I cut some costs. How is it physically possible for a company to experience a drop in total sales revenue, yet simultaneously experience an 18% explosion in their take-home profit?
It all comes down to a financial mechanism called operating leverage, combined with the power of their captive moat.
Walk us through it.
Let's build a micromodel out loud to explain how this works. Imagine you run a factory, and regardless of whether that factory produces one single unit of product or 1,000 units, it costs you exactly $1,000 a day to keep the lights on, pay the workers, and run the machines.
Those are your fixed costs.
Yeah.
The mortgage on the building doesn't care about your sales volume.
Right. The fixed costs are a baseline burden. Now, on top of that, you have variable costs.
Like the raw materials.
The actual cost of the raw materials needed for each unit you produce. In a normal business, if the market price of your finished product drops, say you have to lower your selling price from $15 to $14 to stay competitive,
your profit margin gets squeezed tightly because your fixed costs are still $1,000 a day, and your supplier is still charging you the same amount for raw materials.
because your supplier doesn't care that your selling price went down.
Precisely.
Yeah.
But GPIL is not a normal business.
Remember, their variable costs, the iron ore and the electricity, are essentially locked at rock-bottom prices because they own the mines and the power plants.
Okay, so what actually happened in FY25?
The global selling price of finished steel dropped. The market cooled. That is why GPIL's total top-line revenue went down. They were simply selling their steel for less money per ton.
But if they're selling it for less, shouldn't their profit crash?
It would have if they were forced to buy their raw iron ore on the open market like their competitors. But their input costs didn't budge.
Because they own the dirt.
Exactly.
Yeah.
And crucially, management made a strategic shift. They altered their product mix.
What does that mean?
Instead of just churning out low-margin raw billets, they focused their production capacity on manufacturing more of their high-margin value-added products, like specialized wire rods and hard black wires.
Ah, I see.
Because their massive fixed costs were already fully paid for by their baseline operations, and their variable costs were insulated by the captive mines, almost every single extra rupee of margin generated by selling those specialized wires dropped straight to the bottom line.
Wow.
The efficiency of the machine actually improved even as the selling prices fell. Their overall operating margins expanded to an incredibly healthy 24.32% in FY25.
That is the ultimate defense mechanism. When prices drop, their competitors bleed out. But GPIL just shifts its product mix and actually becomes more profitable.
It's brilliant capital allocation.
And the public markets have clearly caught on to this dynamic. The stock has surged 53.06% in the past year, currently trading at around 271 rupees.
Right.
But honestly, the most vital number in this entire financial stack isn't the stock price. It's the cash flow.
Cash is king.
The sources state they're generating massive free cash flow.
For clarity, free cash flow is the cash left over after a company has paid all its operating expenses and all its capital expenditures, like maintaining its factories and buying new equipment.
It is the purest measure of a company's ability to generate wealth.
And the projections in the notes suggest GPIL will generate roughly 2,000 to 2,500 crore in free cash flow every single year once their current round of expansions is complete.
They are literally drowning in cash. As of right now, they hold a net cash balance. They have a negative net debt of 488 crore.
Which is an anomaly in heavy manufacturing. Steel companies are notorious for being dangerously over-leveraged, constantly taking on massive bank loans to fund their next blast furnace.
But GPIL is funding its aggressive fiscal expansion entirely through its own internal cash generation.
Entirely.
But in the interest of total impartiality, we cannot just paint a picture of uninterrupted exponential glory. The source material highlights a significant glaring weakness in their historical performance.
Yes, the growth rate.
If you look at GPIL's compound annual sales growth over the last 5 years, it sits at a rather sluggish 10.4%.
Yes, that is a stark contrast to their current profit spikes.
And it becomes even more concerning when you benchmark it against their peers. The broader metals and mining industry in India grew earnings at an annual rate of 21.5% over that exact same 5-year window.
Wow. Double the rate.
Historically, GPIL has heavily underperformed the broader sector in terms of pure top-line growth.
And this data point strikes at the central tension of valuing a company like GPIL.
How so?
You have a business that is, at this very moment, an absolute cash-printing machine with a fortress-like debt-free balance sheet. But its historical track record shows sluggish top-line growth, heavily dragged down by its exposure to the brutal cyclicality of commodity pricing in the years before its captive moat was fully scaled and optimized.
Which presents a fascinating puzzle for anyone analyzing this stock. Is the broader market currently mispricing them?
It's possible.
The notes show GPIL is trading at a price-to-earnings ratio, a PE, of roughly 24.35. That means investors are willing to pay 24 rupees for every 1 rupee of earnings the company generates.
Right.
For a business generating thousands of crores in free cash flow, is the market punishing them for the sins of their sluggish past?
Are investors anchored to that historical 10% growth rate and fundamentally missing the fact that the captive moat is now fully operational and immune to down cycles?
It is the quintessential dilemma for value investors. Do you price the asset based on the volatility of its past decade, or do you price it based on its highly optimized, cash-rich, present reality?
A PE multiple of 24 isn't screamingly cheap by traditional manufacturing standards, but for a vertically integrated operator boasting a 23% ROCE and literally zero net debt, a strong argument can be made that they are fundamentally undervalued by a market that misunderstands their operational leverage.
And this immense cash generation leads us directly into our next core question.
What to do with the money?
Exactly. If you are a management team sitting on massive cash reserves, the sources note they have roughly 1,000 crore in liquid cash right now, and you are projected to churn out another 2,500 crore in free cash every year. You cannot just stuff that money under a corporate mattress.
No, you are obligated to deploy it to generate more returns. Capital allocation becomes the primary job of the executive board.
And the management has publicly set an incredibly aggressive target. They want to hit 25,000 crore in total revenue by the year 2030.
That requires roughly doubling the current size of this massive physical empire in just a few short years.
So where on earth is that massive growth actually going to come from?
The growth strategy outlined in the sources is bifurcated into 2 very different paths.
Let's walk down the first path.
The first path is what we can label their core CapEx capital expenditures, directed squarely at expanding what they already do better than anyone else.
Makes sense.
They have committed to a massive 70 billion rupee CapEx plan to construct a brand new integrated plant. As part of this, they are aggressively ramping up extraction at their captive mines, aiming to push mining capacity to 6 million tons per annum by January 2027.
So just digging significantly more of their free dirt.
Precisely, and to process all that extra dirt, they are simultaneously constructing a new 4.7 million ton per annum pellet plant.
This is the predictable, low-risk growth vector. The management team deeply understands mining logistics. They understand the chemistry of pelletization. They have already secured the brutal environmental clearances.
Right. This entire 70 billion investment is purely an execution play. If they build the physical infrastructure on time, they will lower their unit costs even further and have a massive new stream of raw material to push through their high-margin finished steel rolling mills.
Okay, I follow the logic there perfectly. Drill deeper into your established moat, double down on your core competency.
Simple enough.
But then we analyze the second path they're taking to deploy this cash, and this is where the strategy gets.
Well, incredibly weird.
Yeah, let's look at the wild cards. The source material outlines that GPIL is diversifying away from coarse steel. They are currently developing a 250 megawatt solar energy project.
A massive solar array.
And even more shockingly, they are making a 500 crore direct investment into manufacturing battery energy storage systems, or BSS containers.
Grid-scale battery storage infrastructure.
Let me stop right here and challenge this entirely.
Go ahead.
We have just spent the last 40 minutes analyzing and praising this company for sticking strictly to what they know: mining dirt, avoiding toxic debt, and being the most ruthlessly efficient secondary steel maker in their geography.
That's true.
And now, suddenly, the management team is taking $500 million rupees of their hard-earned steel profits and attempting to build high-tech, green energy BSS battery containers.
It seems like a massive leap.
Isn't this exactly the kind of hubristic diversification that destroys great legacy companies? The executives get rich, they get bored of steel, and they suddenly decide they want to be a Silicon Valley tech company. Isn't this exactly how a focused titan loses its way?
That is an incredibly valid critique, and it is undoubtedly the very first highly aggressive question any institutional investor would ask the CEO on an earnings call.
Right. Why are you taking my reliable steel dividends and gambling them on unproven battery technology?
Exactly. But if we look closer at the underlying industrial logic detailed in the sources, there is a compelling defense for this pivot. It is not nearly as disconnected from their core competency as it sounds on the surface.
I am listening, but I remain highly skeptical. Convince me.
Okay, think about what a battery energy storage system actually is in the physical world. Yes, the internal components are high-tech, chemically complex lithium-ion cells.
Sure, batteries themselves.
But the system itself, the massive grid-scale infrastructure required to house thousands of these batteries safely relies entirely on heavy industrial engineering.
How so?
These systems require specialized, hyper-durable steel enclosures. They require massive structural framing. They require highly engineered thermal management systems piped through metal architecture to prevent the batteries from catching fire.
So you're saying GPIL isn't trying to invent new battery chemistry. They're essentially just building the heavy steel boxes that the batteries go inside.
To a large extent, yes. They're utilizing their own internal supply of specialized steel billets and custom alloys to manufacture the heavy physical infrastructure of the BS containers.
Okay, that makes it sound a lot less crazy.
But the synergy goes deeper. Remember, GPIL already possesses deep, decades-long expertise in power generation and grid management.
Because of their captive power plants.
Right. They currently operate complex thermal power plants and biomass facilities. They interact with the national electricity grid constantly, balancing loads and selling their surplus power. They fundamentally understand the physics and the economics of energy infrastructure.
Okay, I see the bridge there. So BAS is an adjacency play.
Exactly. It is a strategic adjacency. Furthermore, the Indian government is currently pushing massive domestic content policies, financial incentives, demanding that renewable energy components be manufactured locally rather than imported from China.
So they're riding a policy wave.
GPIL is attempting to capture that massive macroeconomic tailwind by leveraging their existing steel supply chain and their power grid expertise.
All right, I will concede the point. It is less, we are a venture capital tech startup now, and more, we are bending our own steel to make specialized industrial boxes for the power grid we already interface with daily.
Precisely. And when you look at their solar expansion, the financial logic makes even more direct sense.
Let's talk about the solar.
The sources specifically note that their new 250 megawatt captive solar project boasts an internal rate of return, an IRR of roughly 24% when compared against standard state grid tariffs.
Explain why that 24% IRR is so significant.
Yeah.
Why is a steel company generating better returns on solar panels than a dedicated renewable energy firm?
Because a dedicated solar farm has to sell its electricity back to the grid at wholesale market prices, which are heavily regulated and low margin.
Okay.
But GPILs isn't selling this solar power. They are consuming it entirely themselves to melt their steel.
Captive solar.
Every megawatt of solar power they generate directly replaces a megawatt of expensive electricity they would have otherwise been forced to generate burning coal or purchase at premium industrial rates from the state government.
Which means the solar farm directly reinforces their original captive moat. It drives their variable base costs down even closer to absolute zero, making their finished wire rods even more insanely profitable.
Exactly. It is a closed-loop system of efficiency.
Okay, the logic is sound. It is a brilliantly calculated adjacency. But we live in the real world, and nothing is guaranteed, no matter how good the spreadsheet looks.
No, of course not.
Which makes this the perfect moment to transition to the bear case. It sounds like GPIL is a runaway train headed straight for Profit City right now. They have an impenetrable captive cost moat, massive demographic tailwinds in the housing market, absolutely zero debt, and thousands of cores in free cash flow.
It's a rosy picture.
But every single investment thesis has a fatal flaw. Let's open the what could go wrong files. What are the dark macroeconomic clouds forming on the horizon for GPIL?
The first, most pervasive dark cloud is the fundamental nature of the material they produce. Extreme cyclicality.
Right, the booms and busts.
We discussed earlier how their captive moat allowed them to survive the recent dip in global steel prices while maintaining a 22% EBITDA margin. But what happens if prices do not just experience a temporary dip? What happens if they violently crash and remain depressed for half a decade?
Even with their captive moat, they aren't totally immune to gravity.
Exactly. The moat protects them from going bankrupt, but it does not protect their profit margins from severe compression.
What's the worst-case scenario the models show?
The modeling and the sources suggest that a sustained 20% to 30% drop in global steel prices, driven perhaps by a prolonged global macroeconomic recession, could severely compress their EBITDA margins down below 15%.
Which still leaves them profitable, but...
They would still be cash positive, but the explosive growth narrative would completely stall. And in the steel industry, the warning signs for a price collapse are always flashing in one specific geographic location.
Ah, the massive dragon in the room. China.
Always China.
Tell us about the China risk.
The Chinese domestic economy possesses almost unfathomable steel manufacturing capacity. Historically, when the Chinese domestic economy experiences a severe slowdown, particularly within their highly over-leveraged real estate and infrastructure sectors, they do not simply turn their massive blast furnaces off.
Why not? Just hit the off switch.
Turning off a blast furnace is incredibly expensive and damages the refractory lining inside the furnace.
So they keep producing steel they don't need. What do they do with it?
They export the excess. They aggressively dump it onto the global market. The source material explicitly warns about the threat of China exporting more than 100 million tons of cheap, subsidized steel annually.
I want to push back on this, though, because I think, a listener might be confused here. Earlier, we established that GPIL's ultimate superpower is that their iron ore dirt is practically free. If China starts dumping cheap steel into the Asian markets, why should GPIL care? Won't GPIL's base cost of production still be fundamentally lower than the cost of Chinese steel that has to be manufactured and shipped across the ocean?
It is a great question. GPIL's cost of production will remain lower, yes. But they do not sell their steel based on their costs. They sell it based on the global market price floor.
Oh, I see.
If Chinese dumping forces the prevailing market price of a steel billet in India to crash by 30%, GPIL is forced to lower their selling price by 30% just to match the market and make a sale.
Because no one's going to buy their expensive steel if there's cheap Chinese steel available.
Exactly. Their captive moat means they might still make a tiny profit at that crashed price while their competitors bleed out, but their overall revenue and their massive free cash flow will evaporate. They lose their pricing power entirely.
Understood. It's the classic commodity trap. You can be the absolute most efficient producer on the planet, but if the global market price falls below a certain threshold, your margins are still held hostage.
Exactly.
Okay, that covers the macro risk. What else is in the risk file? What about these new wildcard expansions we just debated?
Execution risk is a massive looming factor. Moving into battery energy storage systems is entirely unproven territory for their management team.
Right, they've never built a battery box before.
Deploying a new 500-core venture is a significant capital commitment. Heavy manufacturing expansions are notoriously difficult to project accurately.
Oh, it usually goes wrong.
If they face unforeseen regulatory delays, supply chain bottlenecks for the specialized alloys, or if the capital expenditures overrun their budget by 20% to 30%, which is entirely common in new industrial ventures, they could end up with massive idle assets.
Tying up hundreds of crores of capital without generating a single rupee of return for years. And beyond just the execution of building the factory, there is a massive technology disruption risk buried in this BS strategy. The source material briefly mentions the risk of battery technology advancing too rapidly. Let's explain the mechanism of why this is so dangerous.
This is perhaps the most existential risk to the wildcard strategy. Current grid-scale lithium-ion battery banks are incredibly volatile.
They catch fire, right?
They are essentially highly controlled chemical fires. They generate immense amounts of heat, and if they experience thermal runaway, they explode. Therefore, they require the massive, hyper-engineered, highly specialized steel thermal enclosures that GPIL is planning to build.
To keep them stable.
Those steel boxes are packed with complex HVAC and liquid cooling systems piped directly through the metal structure to keep the batteries from overheating.
Right. The current technology demands heavy protective steel armor.
But battery chemistry is evolving at an explosive rate. Look at the development of solid-state batteries.
What's the difference?
Solid-state technology replaces the flammable liquid electrolyte with a stable, solid material. As a result, they run vastly cooler, they are incredibly stable, and they pack energy much tighter.
Okay.
If solid-state technology suddenly scales and becomes the dominant standard for grid storage in the next 5 years, you suddenly do not need a massive, hyper-engineered steel thermal container to house them.
You might just need a basic, lightweight composite shell.
Exactly. The thermal dynamics fundamentally change.
Which means GPIL is currently investing ₹500 million into building the absolute ultimate heavy-duty protective steel case for a technology that might completely eliminate the need for heavy-duty protection in half a decade.
Yeah, it's a huge gamble.
It is like investing massive capital to build the world's most advanced, state-of-the-art factory for two-way pagers, right as Apple is stepping onto a stage to announce the first iPhone.
That analogy perfectly captures the obsolescence risk. When you step out of the slow, predictable, centuries-old world of iron ore and step into the hyper-fast innovation cycle of global green energy tech, the ground can shift underneath you practically overnight.
And the sources highlight one more specific risk regarding their capital allocation: logistics.
Yes, there is a brief note outlining a risk regarding GPIL diversifying into the logistics sector. Presumably, this would involve building out a massive fleet of trucks or rail assets to transport their own finished steel and potentially offering third-party freight services to fully utilize the assets.
Which sounds like a logical way to cut shipping costs, but what is the bear case?
The bear case is that logistics is an entirely different business model with brutal economies of scale. If GPL enters this space, they are going up against entrenched, highly optimized legacy giants.
Like who?
Like the dedicated logistics arm of JSW Steel. The risk highlighted in the analysis is that a lack of initial scale and network density in their logistics arm could lead to negative EBITDA margins in that specific segment.
So they'd be losing money on every truck.
Instead of saving money, it could become a massive financial leak, potentially draining 100 to 200 crore of operating profit every single year, while simultaneously distracting the executive team from optimizing the core steel business.
This raises an incredibly important question about corporate survival.
Okay.
When you lay all of these risks out on the table, the very real threat of a Chinese steel dumping crisis, the potential of a rapid battery tech pivot, wiping out a ₹500 million investment, a potential logistics boondoggle draining cash. How much margin of safety does GPIL's net cash balance sheet actually provide against these massive macroeconomic forces?
In the heavy industrial sector, a fortress balance sheet provides the ultimate margin of safety. It's the guarantee of survival.
Right.
In a brutal, prolonged down cycle, highly leveraged companies do not simply shrink. They go bankrupt because they cannot service the interest payments on their massive debt. Their cash flow goes negative, the banks pull their credit lines, and the company is liquidated.
But GPIL simply does not have that problem.
No. Their net cash status means they have the financial stamina to weather a multi-year storm that would literally drown their competitors.
And to address why these specific risks haven't materialized and crushed them yet, the macro tailwinds in India are just too strong right now.
Exactly. The insatiable domestic infrastructure demand in India is currently holding regional steel prices up, buffering them against global weakness.
And crucially, GPIL is funding all of these risky wildcard ventures, the 70 billion capex, the BSS factory, the solar arrays entirely through internal cash accruals. They are not borrowing money from a bank to gamble on battery boxes.
Which means if the solid-state battery revolution happens tomorrow and the BSS venture fails completely and utterly, it burns ₹500 million of cash, it bruises the management team's pride, but it absolutely does not threaten the solvency of the core company.
The blast furnaces keep burning.
Precisely. The core steel operations would continue churning out cash completely unbothered.
Which naturally leads us to the people who are actually sitting in the boardroom making these massive strategic gambles.
The management team.
A corporate ship of this staggering size, navigating through cyclical commodity storms, fending off Chinese dumping threats, and simultaneously deciding to invest ₹500 million in unproven battery technology, requires an incredibly steady, experienced hand at the wheel. So let's turn to our final segment.
The people behind the iron.
Exactly. Who is actually running GPIL, and how are they incentivized?
The governance structure of GPIL is deeply, deeply promoter-driven. This is a very common, traditional structure in the Indian industrial and manufacturing sectors.
Who's at the top?
The chairman and managing director of the company is Bajrang Agrawal, who is also listed in various regulatory filings as BL Agrawal. He has been at the absolute helm of this company for over 23 years, taking the position back in August 2002.
That is an immense tenure. It means he has personally navigated the company through multiple full boom and bust cycles of the global steel industry, including the 2008 financial crisis and the COVID disruptions. That level of institutional memory and continuity is highly reassuring.
It provides massive stability, but it is also a heavily family-run board.
Who else is on the board?
Alongside Bajrang Agrawal, the executive leadership team features Dinesh Agrawal, Siddharth Agrawal, and Abhishek Agrawal, all holding crucial executive director or whole-time director roles.
So the whole family is running the show.
When you aggregate their holdings, the promoter family collectively controls a massive equity stake, totaling roughly 21% of the entire publicly traded company.
Just to put a dollar figure on that level of control, the notes mention that Bajrang Agrawal's personal equity stake alone is currently valued at roughly 16.5 billion rupees.
That is the definition of having serious skin in the game. Their personal wealth is entirely synonymous with the company's performance.
But from a corporate governance perspective, that level of concentrated family control always raises immediate red flags for institutional investors.
Sure, it can be a concern.
If the family owns that much of the pie, and they occupy all the key operational roles running the day-to-day business, who is actually watching the watchers? Where's the friction? Where's the independent oversight ensuring they don't treat a publicly listed company like a personal fiefdom?
It is the eternal question in emerging market governance. Structurally, GPIL complies with all the standard requirements for a listed Indian firm. The board consists of 15 members in total, and 6 of those are officially classified as independent directors.
Do those independent directors have actual power?
Crucially, these independent directors chair the vital oversight committees, specifically the Audit Committee and the Stakeholder Relationship Committee. So on paper, the structural checks and balances exist.
But there is a very specific detail regarding executive compensation buried in the source material that I want to zero in on, because it stood out to me as incredibly unusual for a modern, multi-billion-dollar corporation.
Oh, the flat salary.
Yes. The executive compensation structure for the promoter family is 100% fixed salary.
Yeah.
Documents state that Bajrang Agrawal earns a flat 36 million rupees a year in salary, but there are absolutely no performance bonuses tied to metrics, and there are absolutely no stock options granted based on hitting growth targets.
That is correct. It is a completely flat W-2, so to speak.
So what does this all mean? Let me push back on this structure from the perspective of modern corporate theory.
Let's hear it.
Modern governance preaches that you must link executive pay directly to corporate performance to drive growth. You align their wallet with the shareholders' wallets.
The standard Western model.
Right. If the CEO of GPIL gets paid a flat 36 million salary, regardless of whether he successfully doubles the company's revenue to 25,000 crore, or whether the company shrinks by 50% during a catastrophic steel recession, where is the incentive to hustle?
It seems counterintuitive.
Why bother launching a highly stressful, risky BES venture or fighting through the bureaucratic nightmare of expanding a mine if your paycheck is identical either way?
It is a classic debate between Western compensation models and family promoter models. In a Western Fortune 500 company, the CEO is often a hired gun with a tiny equity stake, so you have to bribe them with massive stock options to care about the stock price.
But with GPI.
But with GPIL, you have to look at the psychology of their total wealth. When your personal equity stake in the company you founded is worth $16.5 billion, your $36 million annual salary is essentially a rounding error.
Wow. Put that way, yeah.
It pays the daily bills, but it is not how you measure your success.
Ah, I see. The equity is the incentive.
Exactly. Their intergenerational wealth, their family legacy, and their societal status are inextricably tied to the underlying enterprise value of the firm, not to an annual cash bonus tied to some arbitrary quarterly target.
Right.
When you own 21% of the pie, making the pie exponentially bigger is its own massive reward. You don't need a cash bonus to care about a $16.5 billion asset.
That makes perfect sense. The alignment is already baked into the ownership structure. However, that heavy concentration of family leadership highlights a completely different organizational risk, one that often plagues transitioning companies: the bench strength risk.
Yes. The limits of centralized, founder-led management.
Meaning, what happens when the complexity of the business outgrows the bandwidth of the family dinner table?
Precisely. The core management team is highly concentrated around the Agrawal promoters. Now, they certainly utilize experienced non-family executives. The sources note their CFO has been in place for almost 12 years, but there is very limited data provided on the deep track record, autonomy, and execution capabilities of the non-family managerial layer.
And as GPIL attempts to violently scale from a 12,000 crore regional company into a 25,000 crore national titan, while simultaneously introducing complex high-tech adjacencies like solar farms and BS battery manufacturing, that scaling effort is going to severely strain their organizational capability.
Scaling a heavy industrial business from 1 to 10 requires sheer willpower and deep operational knowledge. But scaling it from 10 to 100 requires systems, institutionalized processes, and the ability to delegate massive authority to outside specialized professionals.
Can they do it?
Can a tight-knit family board effectively relinquish control and manage a sprawling, multidisciplinary energy and materials conglomerate? Historically, family-run heavy industries in emerging markets sometimes struggle immensely to hand over the reins to professional technocrats.
It is the difficult transition from being a brilliant founder-led powerhouse to becoming an institutionalized national titan that runs independent of its creator. That evolution will be the true defining test of GPIL's management over the next critical 5 years.
I completely agree.
Well, we have covered an immense amount of ground today. We have traversed geology, heavy metallurgy, financial witchcraft, and corporate psychology. Let's try to synthesize all of this as we move toward our final thoughts.
Sounds good.
We began by dissecting GPIL's physical anatomy. They are a mid-cap masterclass in extreme vertical integration. They completely reject the modern trend of outsourcing. They do not just sell a finished steel wire. They violently pull the iron out of the earth, they process it, they melt it down, and they roll it out, powering the entire massive operation with electricity they generate themselves.
And that deep, unyielding physical integration is the foundation of their entire valuation. By owning their base inputs through captive mining and captive power generation, they effectively insulate themselves from the vicious, margin-crushing commodity cycles that frequently destroy their peers. It has transformed them from a vulnerable manufacturer into a cash-generating fortress, operating with zero net debt.
Even though their current market share in the massive Indian infrastructure ecosystem is statistically minuscule, less than 2%, they are perfectly positioned to ride a historic demographic tidal wave of urbanization and government housing initiatives over the next 2 decades. And now, they're looking to leverage that impenetrable war chest of free cash flow to navigate beyond raw steel, pushing into a high-tech, renewable future with massive solar arrays and battery storage infrastructure.
For you, the listener, the ultimate takeaway here: whether you spend your days analyzing heavy industrial conglomerates, evaluating software-as-a-service startups, or designing global supply chains for a retailer, is the profound strategic power of owning your inputs. GPIL proves, in the most visceral physical way possible, that the entity that controls the raw materials and the underlying infrastructure ultimately controls the profit margin. It is true when analyzing silicon chips, and it is undeniably true when analyzing iron ore.
Which brings us right back to where we started this conversation, the physical world. We have spent this entire time marveling at the massive macroeconomic tailwinds of India's steel demand, assuming that building the infrastructure of the future guarantees a bottomless market for GPIL.
Right.
But I want to leave you with a final, slightly provocative thought to ponder on your own.
Okay.
Think about this. What happens to a highly optimized, perfectly vertically integrated titan like GPIL if the very fundamental definition of infrastructure changes over the next 30 years?
It is the ultimate existential question for anyone in heavy industry.
Right. We operate under the baseline assumption that skyscrapers, bridges, and smart cities will always be constructed out of heavy steel beams and high-tensile wire rods. But what if exponential advances in material science, things like carbon nanotube structures, ultra-advanced lightweight polymers, or massive-scale 3D printing utilizing novel composites suddenly make traditional heavy steel functionally obsolete for building the cities of tomorrow?
Wow.
GPIL has brilliantly and aggressively secured 35 years of iron ore in the ground. They have conquered the earth. But what happens to their impenetrable moat if the world of tomorrow simply no longer wants iron?
It is a fascinating, potentially terrifying paradigm shift to chew on.
It really is. Thank you so much for joining us on this incredibly deep journey from the raw dirt of Chhattisgarh to the high-tech renewable grids of the future. Keep digging into the numbers, keep questioning the established frameworks, and most importantly, keep learning. Until next time.